Welcome back to the Global Ledger. I'm Justin. Over the last 20 episodes, we've built the foundation of the modern monetary and financial system, from liquidity to banks to shadow banks to repo to valuation. Today, we begin Arc 2 of our exploration, and this is about institutions, the real players that make this machinery function. And we start with the most misunderstood one of them all, the Federal Reserve. Not as lender of last resort, but as dealer of last resort. This is, I would say, Perry Marilling's one of Perry Marilling's deepest insights, and one of the most important truths in modern finance. And it's something even many economists, I'd argue, don't understand. So let's break it down. So, let's look at textbook view versus real view. In textbooks, the Fed is the lender of last resort. This means, in theory, that when banks cannot meet outflows, the central bank lends them. This idea goes back to Bagehot in the 1800s. Lend freely at a penalty rate against good collateral. And I think the words Perry uses high rate. But as the Fed itself emphasizes in one of the articles that we have been talking about, which came out this summer in 2025, it's titled "The Fed Explained." The Federal Reserve's broader mandate includes promoting financial stability and ensuring the safety and efficiency of the payment and settlement systems. So this is already bigger than lending to banks. Why? Because the modern financial system is not built on bank loans and deposits. It's built on repo. It's dealer balance sheets, money markets, treasury markets, flows of collateral. I mean, this is shadow banking in its whole global dollar funding, right? And when that system is in trouble, traditional lending to banks really, isn't enough. So the Fed must support markets, not just institutions. So that's the transition from lender of last resort to, say, dealer of last resort. So what does a dealer actually do? Dealers do, I'd say, three things. We'll mention three. Make markets. So meaning they stand ready to buy or sell. So that's number one. Number two, they hold inventory. So they accumulate positions when customers sell. And number three, they fund positions. They borrow in repo and money markets to finance assets. So dealers also provide liquidity, price continuity, risk intermediation, and market depth, importantly too. But their ability to do this depends entirely on balance sheet capacity, collateral conditions, funding spreads, regulatory constraints, and volatility, and so on. So when these start to tighten, you'll see the dealers start to pull back. And when dealers pull back, markets freeze. That's when the Fed must step in, by the way. So this is kind of the core idea of dealer of last resort. So when private dealers cannot make markets, the central bank becomes the dealer. They do this by buying treasuries, lending cash and repo, backstopping the dealers, accepting collateral nobody else will. We saw that before. Reducing haircuts, stabilizing funding markets, and injecting reserves into the payment system. So this is, again, not money printing. This is market making at the top of the hierarchy. So a direct function of the Fed's role in maintaining stable payment and settlement systems really is a description in their own documentation. So And there will be a link to that, or just for ease, just type in the Fed Explained 2025, and it should come up right on their website. But let's look at some of the crises that have happened, where we can kind of bring an example to light here. So let's look at 08, highly talked about one, and this is the MBS collateral crisis. So in 2008, the dealers lost funding. I mean, repo collapsed too. So collateral really became suspect. The Fed created lending treasuries for collateral, direct lending to dealers, commercial paper backstop. So that was TSLF, PDCF, CPFF. These are what they created. This wasn't bank lending per se, it was dealer support. So there's something to look at when talking about this here. There's some examples. In 2020, we saw the Treasury market really took a shock, specifically in March. This is where Treasury yields spiked. Dealers could not absorb flows. So you saw the bid-ask spreads just explode. So even the safest assets became illiquid. And the Fed intervened by buying treasuries in unlimited size and stabilizing the repo and then supporting the money markets. They also highlight this in their really in-depth article under, I believe, the Fed's responsibility for stable financial functioning. So there's directly admitting to these very facts we're talking about. So in 2023, there was a bank funding shock, and banks took losses on securities. You saw depositors move funds, collateral valuations fell, funding conditions really tightened. The Fed responded by creating the BTFP facility, which I believe stands for the Bank Term Funding Program. Don't quote me on that. I'm pretty sure. But again, supporting balance sheets through collateralized funding. So not traditional lending. This is really dealer of last resort behavior. So why is it that the Fed must be dealer of last resort? Well, because who else? No one else has unlimited capacity, unlimited balance sheet, unlimited ability to swap collateral, or unlimited trust. So this is exactly what the Fed means in its article when it states the Federal Reserve promotes financial stability and works to ensure that the financial institutions and markets continue to function. In a world built, say, on collateral and wholesale funding, markets fail before banks do. So the Fed must stabilize the markets. It's not about saving Wall Street or anything like that. It's about keeping the Treasury market functioning, keeping collateral chains intact, keeping the payment system stable, keeping these funding markets continuous, and global dollar flows reliable. So if those break, well, everything else kind of goes. So let's talk about how this impacts valuation. And I like to do this because it's important. I think this can touch on a wide variety of folks that are investors or really just anybody with a curiosity for valuation finance, because ultimately asking the question, well, why does this matter to me? So let's look at this. So when the Fed acts as dealer of last resort, it stabilizes liquidity, repo spreads, margin requirements, volatility, funding costs, what else? Balance sheet capacity. So together, these shape the discount rate, risk premiums, and ultimately valuations. So, and we've talked about this before. We did a whole episode on discount rates and risk premiums. So go back and listen to those because it will tie into what we're talking about. So even though the Fed is not directly propping up asset prices, its actions indirectly stabilize the denominator of valuation models. So this is kind of the fusion, say, of the funding side and the valuation side, and I would argue that kind of what makes the global ledger unique. And I'm really hoping that you're enjoying it and getting something out of it. So let's move on to why understanding this removes the fear out of some of these things that happen. There's a lot of headlines, and people get scared, thinking that they're manipulating markets or they're printing money and this is artificial. But when you understand dealer balance sheets and collateral dynamics and funding systems, liquidity microstructure, the mystery does start to disappear a little bit, and you see the Fed's role as structural, not political. So, and with clarity, things can not, seem so scary. So, and it's exactly why this show is here. So, thank you for listening to episode 21 of the Global Ledger. We talked about what a dealer is, why markets depend on dealers, and why the Fed must act as a dealer of last resort. And so, in episode 22, we're gonna stay with the institutional architecture and explore what I think everybody's heard about is primary dealers, and these are the market makers of the dollar world. So once again, I'm Justin, and thanks for listening.